Good afternoon. This is Doug Gerlach from iClub Central Incorporated. Welcome to our Lunchtime Stock Club. Today is Monday, June 8th, 2015. I hope you've got your brown bag lunch or whatever you're having for lunch ready to go. Today I'm having a spinach, kale, pineapple, banana, mango smoothie for lunch, trying to eat healthy and keep my body functioning properly. Maybe you've got something a little meatier in front of you, but we're glad you're here. Today is Monday, June 8th. As I mentioned, we're going to take a look at the market where we are now that we're almost halfway through the year. We'll take a look, an update on a stock that we've been looking at in some of our other webinars, and of course, answer any questions that you have to the best of my ability. A reminder, if you're having technical problems, if you can't hear the webinar, if you can't see and the webinar started and you see the application there, the best thing to do is to get help from GoToWebinar immediately. Don't type in the question box that you can't see, you can't hear, because we don't have the ability to diagnose your problems in real time. So GoToWebinar can help you out with that and give you this troubleshooting tips you might need to get back up and running. But if you can't hear me, if the sound or graphics are choppy, a couple of things you can do. Turn off unnecessary programs, don't connect using Wi-Fi, if possible, and listen using the telephone. Those are some of the key things. But if your speakers are just quiet, the first thing to do is check the volume. And the second thing is to just check the settings in the GoToWebinar application to make sure it's pointing at your actual speakers or headset, or vice versa. Sometimes if you switch between headset and speakers, the GoToWebinar application can get confused. So you do want to make sure that the settings are set up properly. And they've got a sound check application that will help you debug and figure that out in the application as well. If you do have a question, just use that question box. Type it in at any time. We'll answer questions during as well as at the end. Today should have plenty of time for your input and questions. And if you do have any stocks of interest you'd like to share with the group, please feel free to type them in at any time, and we'll pull up Toolkit and take a look, and maybe someone else can offer some information that they might know about that particular company. Sharing ideas is great. That's the whole premise of an investment club. And this Monday Stock Club webinar, I'd like to see more sharing of your best picks right now in the market. And by doing that, maybe all of us can benefit. Our archives are always on iClub.com. I have just uploaded the Toolkit 6 webinar from last week, but I haven't linked it on the website yet, but I'll do that immediately following today's webinar. That was our stock study webinar where we looked at a company. We're going to touch base back with that company today in this webinar. So if you weren't at the Toolkit webinar last week, you may want to review that full webinar to get an understanding of what we're going to be talking about. The Facebook page for iClub Central continues to grow, and we will post updates on the webinars that we do, the archives, as well as special promotions and other information there. Just search for iClub Central, and you'll find our little iClub logo and probably some pictures of me and some posts and other information about our webinars and everything we've got going on at iClub Central. So this month, we are almost halfway through the 2015 calendar year. So where are we? Where do we stand? Well, here's the graph that I like to look at that shows the performance year to date for three major market segments. The top, the kind of forest green line, is the EFA index, the Europe Australasia Far East Index. Was the big winner at our May webinar, and you can see now it's retreated just a little bit, come back down to 7.4%. I see that there's still continuing questions about Greece, about Russia, the international economy. Obama was on television talking about the problems with the Russian economy. Those are pretty well known at this point, but there's still a lot of concerns out there. But having said that, there's been a lot of strength in the the developed world in the stock markets there, as evidenced by this particular graph. So a lot of those countries and companies outside the U.S. have been performing well. The red line is the small cap Russell 2000 index, and you can see that's ticked up a little bit. Last month it was neck and neck with the S&P 500, but now small caps are coming back into favor a little bit, at least in the short term, and the broader market, the large cap, is now down to just up 1.3% for the year, giving up a little bit of the gains that it had earlier in the year. And I think as the bull market continues to grow old by bull market standards, there's going to be pressure and a lot of investors perhaps thinking the market is a little overvalued, and maybe we'll start to see some valuations come back, and that might prompt something of a correction of the broader market. And this is kind of the typical choppiness that we've come to expect from the markets in the U.S. Investors not quite sure. We're at an unusual time with bond yields being at so low for so long, and now that they're threatening to tick back up again, they're still just not attractive enough to pull people out of the stock market. So what do investors do with their capital? Where do they put their cash? That's a big concern, and I think that's helped buoy the broader market, the stock market, a little bit, but where we may be heading in the next 6, 12, 18 months, again, there are, I think, a growing number of questions. The economy again, shows lots of positive signs, but it's not overwhelmingly positive. Things are definitely improving in a lot of sectors of the economy, but we're still not at the point that a lot of people would feel most comfortable in terms of the recovery since the recession, which is now so long ago that it's hard to even remember what happened. But we are still chugging ahead, and the market is still up. When we look at the valuation of the S&P 500, here's my graph. We're actually down a little bit. It doesn't show on this graph, but last month at our webinar, the PE ratio was about 20.6, I believe. And yeah, 20.67. Now it's 20.339, and that's the first time that PE ratio has declined, since going back to 2011. That PE ratio on a monthly basis, on a fairly regular basis, has been ticking up, and now we see just a tiniest bit of decline, and I think that's just partially due to concerns over company profitability and the general elevated level of the market. So I think that would be pretty healthy. The red line indicates where we are now, so you can see historically when the market has hit 20, what's happened after that. 20 is a pretty rich multiple for the S&P 500. Historically, in the last 20 years, it's peaked at much higher levels, which we would consider pretty unreasonable. But I think, again, we're not in frothy bubble territory just yet, and there is a lot riding on company profits coming in for the first quarter is reported now, so we're looking at the second quarter ending in June, and then we'll know more at the end of July and August how companies have been performing in the second quarter. And so I think there's a little bit of an expectation that maybe profitability won't be as high as was initially expected, and that's kind of pushing the market down a little bit. So as always, we're going to be looking at companies that may buck the trend, maybe are solid no matter what the economy, overall market will tend to do. We're going to look out for values in the market when we can find them, and we're going to focus on buying individual companies. That's what we do, and that's our key strategy for coping with the volatility and the overall risk-reward formula for investing in stocks, buying good companies at good prices. So I have some thoughts this month from Benjamin Graham, who is one of the leading investment thinkers of the 20th century. He, with his partner Dodd, wrote Graham and Dodd's security analysis. Following the stock market crash of 1929 and the subsequent economic despair, and the stock market really took a hit. And Graham and Dodd really put together a regimen of analysis techniques that could be used to help find good companies that provided acceptable returns with an acceptable margin of safety. Margin of safety was the phrase that Graham came up with to describe investing in stocks that had a good upside relative to the downside. They would have a margin of safety. Graham was the primary mentor of Warren Buffett, who studied with him, and Warren Buffett took a lot of Benjamin Graham's techniques and over the years has expanded on them, but still remains firmly in the Benjamin Graham camp. You may not know this, but Warren Buffett actually named one of his sons after Benjamin Graham, at least gave him the middle name of Graham in honor of his professor and mentor. That security analysis book is an interesting read today. Historically, a lot of the concepts are not as compelling today as they were at that time. There's a heavy focus as value investors on the dividend, the cash that's coming back to investors, and dividend yields have shrunk over the last 75 plus years. So it's a lot harder to focus an analysis technique on individual equities, I think, that's based in dividend payouts when companies are retaining more of their cash and using it instead to expand or to do share buybacks that also have the benefit of increasing a company's earnings per share. But anyhow, Benjamin Graham once wrote about diversification, and I think this is really an interesting to us and as relevant today as it was at the time. He says that diversification is an established tenet of conservative investment. By accepting it so universally, investors are really demonstrating their acceptance of the margin of safety principle to which diversification is the companion. Graham like to compare the concept of a margin of safety to the insurance underwriting business, where you're taking on risks, but you are hopefully going to make a return at the end of the day. You accept that the risks are happening. You know that there are going to be insurance claims that will have to be paid out. So managing the business wisely does not pretend that you'll never pay out any claims if you're an insurance underwriter. And it depends on having a broad base of business. If you have a lot of different policies, then the chance that many of them will file claims goes down significantly. And if you think about that, that's what we do when we invest in stock market. There's a close correlation. Graham also wrote, there's a close logical connection between the concept of safety margin and the principle of diversification. One is correlative to the other. Even with a margin in the investor's favor, an individual security may work out badly, for the margin guarantees only that he has a better chance for profit than for loss, not that loss is impossible. But as the number of such commitments is increased, the more certain does it become that the aggregate of the profits will exceed the aggregate of the losses. So it's a pretty direct admonition from Benjamin Graham to not put all of your eggs in one basket. It's a basic concept that many investors learn going out, that it's good to diversify. It's also not good to over-diversify, but we'll talk about that at a later date. But one of the key principles of the value approach that Benjamin Graham taught, and the principles of investing in individual stocks, really hinges on having a reasonable level of diversification in your portfolio. So let's go on and talk about the company, a company of interest. And I wanted to touch base with United Natural Foods, ticker UNFI. We covered this last week in my Toolkit stock study. I did a live stock study in the Toolkit webinar series, and we looked at this company. We did a pretty lengthy webinar. We went over in time. We really kind of dug deep. We looked at the company website and the company presentation to kind of get up to speed quickly. I'm interested if any of you took a further look at UNFI. If you have any research to share or information or opinions, please feel free. This is a mid-sized company with sales last year of $6.79 billion. They're a distributor of wholesale, organic, and natural foods. And their biggest customer is Whole Foods Market. And in fact, Whole Foods actually sold to UNFI some of their distribution capacity, figuring it's easier to let UNFI deal with it. They can actually handle the distribution to the Whole Foods stores at prices that Whole Foods itself couldn't do. But they've got an enormous capacity, and they're building out that capacity. So the driver here is increased interest in natural and organic foods. That's the base thesis of why you might look at this company. On a secondary note, if you believed that there's going to be an increased interest in organic and natural foods, but you didn't want to commit to any particular company, there are a number, besides Whole Foods, there are a number of other businesses that are focused on organic food retail. So grocery stores like Sprouts, farmers markets, and others that are in this space. And the problem is picking the right one in this kind of emerging stage of growth for this particular segment of the food industry, the food retail industry, could be a little tough. But UNFI has a large presence across the country in some key geographic areas, and their biggest competitor is privately owned, and so there is a lot of fragmentation after that. So there's a lot of room for them to pick up capacity, pick up customers, increase what they're selling into each customer's stores. That's a big driver as well. Traditionally, they started off with prepared foods, so dried foods, foods that were shelf stable for a long time, and they've expanded into frozen foods because consumers are increasingly looking for a convenient meal, and if they can be convenient and healthy, throw something in the microwave that's all natural, that's organic, that meets their dietary requirements, that is a win-win. So UNFI building out their refrigerated warehouse space, and that's they've got a lot of capacity there. UNFI will just pop over. Let's look at their growth trends. This is why this company is interesting to us as Better Investing / Toolkit 6 investors. Consistent growth, moving in the right direction, sales on top, pre-tax profit in pink, earnings per share on the bottom, and then the high and low price bars at the very bottom. Analyst estimates have been plotted on this graph, so you can see there's a big sense that the company will consistently grow moving forward. One note, we are using the non-GAAP earnings for the last quarter. There was an adjustment there, so we made a little bit of an adjustment to the data. So this won't look quite the same if you pull up the data right now in your Toolkit or SSG program, but it looked like it was a non-recurring item, so we made a little adjustment to our data, and then it turns out everything was right on trend. The company says that they expect non-GAAP earnings this year to be between 15 and 18%. So they're really signaling that they expect this to be a pretty good year. In this analysis, the growth rate that's projected out is 15%. The analyst consensus is 14 point something, so you could round it up, round it down. I think it'll be in that 14 to 16% range, but that's for everyone to make their own decision about it. That does kind of assume quite a large expansion of the business, but through acquisition, through selling more sell-through in the store to increase more items. And to that end, the company is pretty optimistic. They're so optimistic that they're building out additional capacity. If you're in this distribution business, you have to have capacity to distribute items if you want to grow your business. You can't go to a grocery store and take orders for products that you can't deliver. You have to have those products available for quick delivery in order to service those. The grocery store business is has a high level of spoilage, and as well as price competitiveness. So you have to be able to serve those businesses pretty efficiently. So the company's expanding out, and I think it's taken a little bit longer than they expected. So there's a little bit of concern that it's going to cost more to build out that capacity. And then what's the payback period on that expansion? Are they going to be able to grow the business fast enough to make it have been a worthwhile thing to build out that capacity? So I think that's some of the concerns about UNFI. Now, the thing is with this analysis, the other thing that we did here, the second quarter is based on the estimates for the second quarter of the company's year. That's not actual data. And that second quarter results are being released today, June 8th, after the market closes. So then we'll know. So the last week we were leading up into earnings season. This week we're leading up to the earnings release, which is going to happen today. Before we look at the price and what's happened since last week, here's the pre-tax profit margin trend. So the last 6 years have been stable. Little bit of an uptick in the last year, which is pretty positive. That 3% range is pretty good for grocery stores in general. We looked at the food distribution market industry. We looked at the food industry, the food distribution industry. If you look at those, we looked at the peers, and some of them are obviously outliers. There was one company that was distributing food in Israel. We struck that off the list. That's just not appropriate to compare this U.S. company to a company across the ocean. Then we looked, and there were a couple of specialty distributors who had slightly higher margins. But compared to its peers, this is actually a pretty good margin, and certainly the trend is pretty good as well. So we didn't have much concerns with that. Now, when we looked at it last week, this is Monday, Tuesday, Wednesday, Thursday. Tuesday, Wednesday, Thursday, Friday, and Saturday. And this is something new with Yahoo Finance, where they've got the after hours markets there. Those little moon and sun icons, those dotted lines reflect the after hours trading, so they kind of isolate that from the market open trades and what was happening with the price. So we looked at it Tuesday night. So that's the first left-hand bar on the. Let me illustrate it. I do have the tools here to do that. So this is Tuesday. So it ended the day right about 66. Something happened on Monday, the price came down, and then on Tuesday, Wednesday, on Thursday the price came down, and then on Friday it really settled down to the 63.75. So it took a 4 to 5% haircut over the last couple of days. Now you can look it up on Yahoo Finance, and there are no news headlines where any there were no analysts that came out with downgrades. There have been some analysts who have lowered their estimates. If you look, I'm going to flip over to my web browser. Here is the NASDAQ, NASDAQ.com, where we can see the analyst estimate consensus for the next 4 fiscal years. And you do see over here that a couple of analysts had downgraded, revised downward their estimates over the last 4 weeks here. So 4 analysts had downgraded their estimate, their consensus, their estimate for earnings over the last 4 weeks. 3 had downgraded their estimates for the second fiscal year going forward in the last 4 weeks. So there has been some activity leading up into this, and there's no way of knowing is this because someone knows something, or is this just the earnings whisper market out there, so that analysts are kind of have a sense that the earnings are going to be a little less than the consensus and are kind of letting that word get out on the sly. It's impossible to tell, but that's what I presume is happening with the company. And here, if we come over, here we are interactive, so we can see the price right now. So it's already, it took a little bit of a haircut from the perspective of us. If we believe in the long-term potential, maybe the price is a little more reasonable at 63 rather than at 66, 67, where it had been a week ago. But I think it's a good learning moment to kind of see what happens leading up to the release of earnings. Often you see a little bit of increased volume. You see a little bit of trepidation. Maybe some investors might be concerned that the earnings are not going to come in as they expected. It could be that the price leading up to this has already priced in the expectation of what earnings are. And that's why prices don't change when companies report positive earnings, because that factor has already been included in the valuation by the market. So it's really impossible to say. There's no right answer, wrong answer. We can only merely speculate as what's happening. But it is kind of interesting to me. And on the one hand, if you were positive about the company, you might say, well, this is a good deal. If the company comes in with better than expected results after all of this sort of downgrading that's happened and investor cooling of interest, will say maybe this could be a good buying price. It's really one or the other, and then we'll know tomorrow. We'll have a better sense of what's going on. If we fire up my toolkit here, based on our analysis, using that 15% growth rate, and again, the company's guidance is that they expect that at a minimum for 2015. So maybe not for this quarter, maybe they're wrong. I don't have a sense of the track record of management when it comes to releasing guidance, but whether they're conservative or whether they're aggressive, most companies don't like to be too aggressive, because then they get hammered when they're wrong. They'd rather be wrong by being a conservative and then surprising the market with better than expected results. Not only works for so many quarters, so many fiscal years before the market wises up, and then every time the company says something, provides guidance, the market says, oh, well, what they really are saying is something a little bit higher than that. But at least that way the company is not culpable if they do fall short, maybe come in at the actual number. They can't be sued for providing bad guidance, or that they should. Investor lawsuits will claim they should have known. They can be conservative. So that's the way that the guidance game usually works. So here we have our. Let me go ahead and save this. I've eliminated my my high and low PE ratios. Let me go back to my data here for a second, just check out and see where we are. Yeah, okay, so I didn't save the third quarter data. So we plotted it in, and then I didn't save it. So see if I got my current PE ratio showing as 0 here. It's really 23. I'm just going to kind of refresh this for just a second, see what's going on. Well, let's look at the current PE. If we say that the current PE is 23, which is right up here, I think because I've mucked around with the data that it's not displaying properly. there's a third quarter data that's in the program as empty, and the program is still going with that. So what do you think the average PE ratio is? Well, here's the problem with the average PE ratio for this company. It's been richly valued for the last 5 years. The PE ratio has actually reached 31 in the last 52 weeks. And last year it got to 31.7, but you see it's been in that 28 to 30 range on the high side. On the low side, the low PE ratio was 23 last year. The low PE ratio this year was in the last 52 weeks was 21. So it's a really very richly valued business. So there's a lot of expectations built into the price on a regular basis. So for me, if we expect the company to grow at 15% a year, really the highest PE ratio that I like to assign to the company is 150% of 15, or about 22.5 or 23. Right, so that's just my rule of thumb. That's what you find on the high side for mature growth businesses, that their PE doesn't really get much above 150% of the earnings per share growth rate. So if we're expecting growth around 15%, that 15, it's easy to figure out. 15 divided by 2 is 7.5. 15 plus 7.5 is 22.5. So 22.5, 23, something like that is at the high end. Now for this company, because the market has treated it with such a rich multiple, I bumped that up to 25. I don't think that's unreasonable if they come in at 15%. If they come in at 18%, 25 might be a little low, but we'll see where they fall. But that would give you a price of $136 in 5 years from today's $63.80. So that's a reasonable return, no dividend to concern with. On the low side, then, which of those PE ratios? 14.6 is pretty close, is the lowest of the last 5 years. And again, I would, for a company that was growing at 15%, a low PE of 15 is a little bit low, but it's not unreasonable, and certainly the company has been above that in the last 5 years. If you look at the last 10 years, the high PE ratio has been a little bit higher, but also the low PE ratio has been a little higher. But we'll focus on this 2008, 2009 period going forward, or maybe 2010. And you see that kind of the valuation range of the high and low PE ratio. So for me, I set it at 15. Again, you can eliminate these as outliers because that's the way I review them. And what do you end up with? 22.5 and 14.5, which is pretty much the range you would expect for a company growing at 15%. So I rounded those up to 25 and 15, give it the little benefit of the doubt. And then our estimated low earnings per share, including the estimates for the quarter that's being announced today, gave us a low price of $42.40. And that's pretty close to the average 5-year low price, the recent severe market low price of 47. So it's a little bit of a downside from there. It's more than, much more than 20% off the current price, but even so, it still shows up now in the buy zone at 3.4 to 1 with a 16.4% total return. So of course, the risk could be that their earnings that they're coming out with today will have a surprise for everyone, and tomorrow when the market opens, it'll drop a few more dollars in price. We're saying it could go down to $42. So, but we have to measure the risk of that happening and the risk of the upside if they perform reasonably well. Mary says the current PE is 24.5. My forecast for sales growth is 13.8%. Does this tell me the PE is too high? Well, as we went over, I generally don't compare the PE to the sales growth rate as much as the earnings growth rate. I think, I've rounded this up from from 15% to sales growth rate. I think that 13 to 14% is probably more realistic over the long term, and that there will be a little bit of margin expansion. And logically, if you think about the margin expansion possibilities for a company like this, well, how are they going to reduce their overall costs? Well, once you build the warehouse, whether you sell 10 items or 100,000 items out of it, you still have to maintain the cost of the warehouse, much of the cost of it. And you can add employees and add capacity within your warehouse, and you can add more trucks, but more trucks means more delivery. If you can fill up those trucks with more products for each store, then your margin is going to improve. So I think that's what the market is looking at, what analysts are looking at happening here. So yeah, I think that the possibility is that sales are going to grow a little bit higher than earnings over the next few years because of this increase in capacity. And you can see the historical growth rate has been 13.8%. The earnings growth rate has been 10.9%. And the company says, that they've been in kind of building up their business mode, and that growth is accelerating. When we look at the historical growth rates, you can see the sales growth rate increasing over time, and the earnings growth rate in blue has been increasing. That's the percentage growth rate. So it's been much higher. It's been in the last 3 years, it's averaged 6, and 2 years, it's averaged 16.3%. It was 15.5% last year, and the sales growth rate has been declining a little bit. And that's the law of large numbers, I think, playing out on a smaller scale here. So yes, established that it is richly valued by the market. It's not nosebleed territory, but you might get a little dizzy if you had paid a PE of 30 or 28 for the stock. Now it's at 23. If you could have bought it when it was at a PE of 21 in the last 52 weeks, you'd be a little happier right now. Walter says, what's the distinction between organic and natural foods? Well, this is an issue that the regulatory agencies are addressing, because there aren't any regulations about what is natural. So you can have natural on the label, and there's no regulations around it. Organic, there are some regulations and some standards for what determines organic. That means that they haven't been grown with pesticides or artificial, mostly pesticides, and they have to be grown in fields that haven't had pesticides used on them for a certain number of years. So there is some risk there that there could be a shakeout of some natural foods that are no longer would be considered natural if there were some changes in FDA labeling and requirements there. But there are all sorts, and so natural would mean essentially the common understanding of natural means that they are not made with artificial substances like preservatives typically, or dyes. So if there are dyes, colors that are added, they come from a natural source instead of a chemical source. Natural goods typically would not have a lot of preservatives and might not have as long shelf life. Of course, frozen foods, as long as they're frozen, would be fine. And those natural food players strive for a product that doesn't have a lot of additives in them. Now, the thing about the natural foods market is that many of those brands, if you go to the grocery store, they're still isolated in one section. Many of those brands are owned by much larger companies. Like, so Morningstar, there's a brand called Morningstar in green boxes that makes vegetarian burgers and frozen entrees. They're natural, and they include a lot of grains, and they're owned by Kellogg's, because they bought the business. So there is some concern there, but as the CEO points out, so all of us baby boomers, if you're born after the 60s, you may or may not have an interest in natural and organic foods, or up to some level, or natural organic cleansers. But the millennials, the generations that have come along since that time, have grown up with recycling. They've grown up with natural foods and organic foods, and they're much more highly primed to look for natural and look for organic foods, and they're much more likely to shop at places like Whole Foods than the older population. And of course, there's crossover. That's why grocery stores have organic and natural food sections. But if you go into Whole Foods, by and large, I think the customers there are somewhat younger than the customers at your local Albertsons or Stop and Shop or Giant, whatever your Kroger's, those businesses. So that's the tailwind that's helping to drive this industry, is just increasing interest in natural and organic foods and eating healthier. Yeah, Michelle says that I've heard that Whole Foods is facing considerable competition, most recently from Target enhancing their offers. How tied is Whole Foods to UNFI, and who are their other customers? Yeah, UNFI has a close relationship with Target, and they are some of their major customers. Let me pull up. I think I have a file here. I was going to pull up some of their customers. Include well, just give me a second here. I'm gonna pull up. I've got a document here. I've got their investor presentation that talked a lot about their percentage holdings and what their business is by segment. So my computer is kind of grinding away, and let me see if I can dig up that file. On the UNFI website, if you go check it out in their investor relations area, they've got a good investor overview section that has a lot of information about their business and talks about who their competition is and who they think their competition is, and how they are responding to competition, and again, who their big customers are. So here I found the file. This is their investor presentation from January. So I'm going to flip through this kind of quickly. So here are some of the brands. They have 40,000 customer locations, so stores they serve with 80,000 products. They have customers in the U.S. as well as in Canada. Some of the brands, again, you wouldn't know them, but you would know Albert's Organics, maybe, or Select Nutrition, Blue Marble. So those are some of the products that they serve to their customers. They're the market leader. They're the largest in the U.S. and Canada. You can see here in the pie charts, 33% of their business is the supernatural store. That means those are supermarkets that are all natural, like Whole Foods. 27% of their business goes to conventional supermarkets. Independent stores get 33% of their business, and other is 7%. I don't know what other is. The independents are the small health food stores, so still a big part of it. But you can see that the Whole Foods segment, which would be included in this supernatural segment here in this pie chart, it's not overwhelming. Certainly, if Whole Foods is struggling, UNFI might have a gap to fill, but they are not, I don't think that's an excessively high percentage of their business. They have 33 distribution centers, and you can see they're in pockets where where they're close to customers. That's the idea. And again, you see statements like they're interested in their reduced carbon footprint. As a distributor of natural organic foods, they want to be close to customers, and they want to be a green business all the way around. They have the largest freezer and cooler capacity in the industry, which is kind of interesting. And so they'll talk about the market fundamentals here. Highly fragmented market, $109 billion of natural products being sold in the U.S., 88 billion of specialty products, so the non-food items there, really driving the growth rate. Natural products are growing 10.5% a year at retail and 8% and the specialty products are growing at 8% a year. So there's a lot of growth in this particular part of the business. They have one national competitor, which is 40% of their size. That's just a couple of the high points. You can take a look at this PDF on their website. It is really interesting if you're looking at the company there. Gene says, how do you feel about the very low margins for this kind of business? Yeah, that's a great question. Let me flip back. Again, as long as we're comparing apples to apples and oranges to oranges, we're in pretty good shape. The pre-tax profit margin trend, as you see here, is pretty stable, but it is very low. But when you compare this to a software company or a technology company, those margins are going to be 10 times as high, in the 30 to 40 to 50% range. But this is the nature of the business. There's a lot of spoilage. There's a lot of price. Not a lot of price elasticity. Consumers, when they buy food, are very price conscious. In the U.S., food prices are highly government subsidized. We have some of the lowest food prices in the world relative to average income, in the developed world at least. When you go to Europe and you go to the grocery store, the same food items are going to be much more expensive relative to the currency, of course, but we've been spoiled a little bit by this, and that keeps margins down. There's only so high that you can push prices before customers will find other opportunities. So that forces the margins down very low across food distribution and grocery stores in general. So my feeling is, as long as we're comparing favorably to the competition, I'm not worried about the low margins. The companies are going to continue to grow their businesses. There's going to be less cash available for them to expand. UNFI has borrowed money for its building out its capacity, so they've taken on some additional debt. But again, that's not uncommon in the grocery store and food distribution markets. So I'm not worried about it personally. I wouldn't load up my portfolio in a lot of low margin businesses, but as part of your diversification scheme, I think it's a fine thing to do when you find the right company. Lolita says, what's the formula you just calculated for future earnings from the growth rate? And my formula is high PE. I'll do this interactively so we can see it. The high PE should be no more than 150% of the EPS growth rate. And I would say projected EPS growth rate. So I'm going to change that. Projected EPS growth rate. And as a good exercise, go through the stocks in your portfolio and just see where the high PE ratio is relative to that. I think you'll find people intuitively kind of find their way into it. If a company's got a 15% growth rate, they would be valued at a high PE of 22.5. If the company had a 10% growth rate, their PE would be 15. If they had a 30% growth rate, their high PE ratio would tap out. We tap it out at 30. But for a company growing at 20%, which is the maximum growth rate, right? If you think about it this way, the maximum growth rate that Better Investing members are taught to use on their stock selection guide is 20%. That's a very rigid rule. And again, it's not necessarily the case all the time, but projecting growth above 20% over a half-decade period is foolhardy. And so everyone is discouraged to restrict your growth rate, max it out at 20%. If a company grows faster than that, that's great, but any company that you expect to grow faster than that has a much greater risk of underperforming, of damaging your portfolio, your cash position if it underperforms your portfolio valuation. So assume that 20% rule. And then what's the other rule that we learned about high PE ratios? Don't use a PE ratio higher than 30 on the back of the stock selection guide. And that's this formula. 150% of 20 is 30. So, and again, the easy way to figure it out is we're going to take the growth rate, we're going to divide it in half, and then we're going to add that half back to the growth rate, and that's 150%. So that's this is for a non-math person. This is just an easy way to calculate it. So EPS growth equals 20% high, and this is the projected high PE is equal to 30. And we can do the same thing. EPS growth equals 15% high PE equals 22.5. EPS growth equals 10%. High PE equals 20. No, I'm sorry. 10%. Yeah. So high PE equals 15. Louis says, how do you get the graph for sales growth and earnings per share growth? I assume you mean the historical. So first we click here to get our visual analysis, and then this is the historical growth icon up here at the top middle of the Toolkit visual analysis window. Click on that, and this shows the growth rate change over the last decade. So the change in growth rate for multiple year periods. So we're looking at the 10-year, then the 8-year, then the 9-year. Well, we look at the 9-year, the 8-year, the 7-year, the 6-year, 5-year, 4-year, 3-year, 2-year, 1-year growth. Those growth rates are plotted there. So you can look at this graph and you can see if the company, you can isolate if a company is very stable in their growth rate, or if the growth rate, which is common, is slowing. It'll show up in this graph. In this case, you see the slowing growth for sales, but you see the increasing growth for earnings, steadily increasing over the last period. And that's what makes this company kind of interesting and unique and a good case study for us to take a look at, because the growth rate, that blue earnings line, is getting higher over time. A little decline this year, but it just means throughout all of those periods, the growth was edging up for earnings per share. In a couple of years, it was moving right in step with sales growth, but then they kind of reached that point where sales declined, but they had the ability to manage their margins such that earnings still continued to go up. So kind of interesting there. Paul, I don't know what 152 means. Sorry. And Stephen asks about ITC, which is one of the companies that we track in the small cap informer. It's a utility. Let me update our data here. Oops, there we go. Update the data, and you can see this is a utility based in an electric utility based in Michigan. You can see it's a very stable growing business, kind of, and a little high growth rate for the business I think in this study we're looking at 13% growth. I'm not sure what what we're currently calling that in our small cap informer. I'll kind of jump over and see if I can dig it up real quickly. We just updated, it just came out in our update in our last issue. Earnings came in flat for the quarter. I'm not the analyst who covers that company, which is why I remember seeing the update and reading it for grammar, and I don't remember the content of it at all. So I'll pull it up. We looked at ITC last year during this webinar, the lunchtime webinar. So I expect some of you may have taken a look at it after that. On the backside, you can see the margins have been trending up, which is interesting for regulated utility. Let me flip over to the back for you. Here's the margin graph. This is one of the things that made the company look interesting to us. I mean, this has got to top out at some point, but they've been acquiring businesses and kind of expanding there. So it's been an interesting business to take a look at. If you look at the operating earnings, they actually were up a little bit, so that's not reflected here. Operating earnings in the latest quarter were 47 cents, not 43%. So again, that's something that you learn from your research. So I'll just plot in 47 cents. And then all of a sudden, instead of a 1% decline, it's a 7% increase, a little bit higher than the sales increase for the quarter. So that comes from what they're doing. They had a little bit of non-recoverable bonus payments with one of their subsidiaries, and they expect their operating earnings guidance to be between $2 and $2.15 from $1.56 for the full fiscal year. So they're 1/4 of the way through the fiscal year, and they're still looking at $2 to $2.15 of operating earnings. So remember, for this company, you need to look at operating earnings, and we would take out, which are the non-GAAP earnings, we would take out the one-time charges there. Based on everything else, if I do a quick run through, current PE is 21, pretty rich. It's at the low of the 52-week range, and so we're still showing it as a buy. I'm going to flip over to my what we said in the issue last week. Yep, still seeing 13% growth. Buy up to 35, 36, 37, so somewhere in that range. Downside price, and let's see. Total return still in the 15% range. So this is a little aggressive. Maybe this low price is a little too high, but the fundamentals still seem to be in place. Again, the debt load for a utility is going to be high. That's how they got to build out capacity and make improvements and then get reimbursed by being able to raise rates as a regulated utility. Do you have any specific questions about it? I think it's an interesting company to kind of take a look at. It's a small utility, so there are some challenges there, and there's a little bit of a yield, so 2% yield or so on average. It's going to give you a little bit of return there, and that's going to help balance it out. But they are in growth mode. It's a utility in growth mode, not in mature growth phase. Yeah, Michelle. The opinion, Michelle, is that that this is a company that is disappointing a little bit. If we're only growing earnings at 7% and we're looking at 13%, they don't pay enough of a dividend out to satisfy yield investors. They're not growing fast enough to satisfy growth investors. Growth investors tend to avoid. We like this company because this is a way to diversify your portfolio with a business that's pretty consistent, where there's a lot of information that's known about it because they are a regulated utility, where the potential for growth is kind of baked into the price. That the high and low range is pretty tight price-wise from year to year, and we just think this is an option for buying a utility and getting a little bit better return than buying a more established utility, where you're going to be locked into the dividend yield is a key part of the return, and that's going to be taxed, at a higher rate than your capital gains. So all in all, we favor capital appreciation over dividends because of the taxation and because we want the company to be growing, and we want that growth to result in more capital appreciation. So that's why ITC is interesting. But if you were a dividend investor, you wouldn't be interested in ITC as much. Okay, good. Walter asks, I assume, Walter, you're asking about UNFI, where the growth rate has been declining. Yeah, certainly that's an issue if it's declining over a number of years. When you look at UNFI, again, what's the interpretation here? Well, here they were growing at kind of a very consistent pace, and then they kind of saw a bump up, and then they saw a little bit of a decline. But the declining growth rate of sales in itself is not necessarily, not immediately, a red flag, because this is what happens as companies get bigger. It's really meant to help guide your future assessment of what you expect the growth to be. So yeah, in the last year they only grew 12%, and we're projecting growth of 13 to 14% over the next 5 years. But we're taking into consideration the expansion of capacity that they're building out right now, and there are risks with that. There are risks they have to find the customers to make the sales to make that capacity actually serve the function of the business. But the the question you have to decide is whether that assumption warrants investing in the company right now, or if you'd rather wait and see. As I said, the market has been very generous with this business. So investors have liked this business for some time. It doesn't have all of the risks that investing solely in Whole Foods brings, but because you get a little bit of broader customer base across wide geographies. Joe says, any thoughts on bioreference labs? And I'm going to defer because we cover that in the investor advisory service. So I'm going to let our analysts talk about that in the next issue. And OPK, yeah, not a company that I'm familiar with, another biotech. But for my mind, just seeing this, where the company doesn't make any money, is enough to throw me off. And this would be a speculative use of funds, not an investment. I'm just gonna look at the data real quick. Yeah, so they've got there's a real strong trend here in earnings, and that's they're losing money. So yeah, there's a share price, $16. It's been as high as 19, as low as 8, and the price has grown consistently. So I don't know anything about the business, but this would not be something that I would consider part of a core portfolio holding. This would be more speculative. If you know something about the business and you wanted to put some of your high risk capital towards a company like this, that would be purely within your discretion. But from my perspective, without earnings, there's no way to really evaluate it. So Lalit asks, what do you think of Berkshire Hathaway B shares? Again, Berkshire Hathaway doesn't reflect well on the stock selection guide, but again, it's the wrong tool to analyze Berkshire Hathaway. Berkshire Hathaway is almost like a managed mutual fund. It's a managed portfolio of businesses. It's not an operating company where they're actually making stuff. They are owning a lot of different businesses that provide services and products across a wide range of industries and sectors. Warren is not always right, but he's right often enough. The difference between the A shares and the B shares, the B shares are lower priced, and there is some arbitrage that can be there. And Warren's actually provided guidance about whether you should buy the A shares or the B shares when the arbitrage difference is significant enough. He'll say buy the B shares when they're more than this percentage away undervalued from the A shares. Otherwise, buy the A shares if you can. So I'm positive. My feeling is that over time, the Berkshire Hathaway is probably likely to continue to perform well, and as part of a diversified portfolio, this is probably a good holding that you may very well consider. But I'm not going to look at it in Toolkit. It just doesn't work with a Toolkit style analysis. So I've been in investment clubs that have owned Berkshire B, and we were quite happy with the performance. You can find different websites and pundits that'll look at the discounted cash flow and the fair market value of and calculate that out for you for Berkshire Hathaway and kind of give you a sense of, is now a good time based on the company's business to buy shares. But I have no other opinion other than that. Oh, look at the time. Well, let's wrap it up. I'm heading out to Richmond, Virginia this week for InvestEd 2015, and then I'll be back in San Francisco at the Money Show in July. I've got 2 classes and a panel with Mark Holbert and some other investment newsletter editors. In September, I'll be in Central Pennsylvania for their Education Day on September 5th, September 12th, out to Chicago for their local investor conference, and then back to Philadelphia in December. That's what I've got on my schedule right now. I expect will be a couple of more items there that'll be added in the next couple of months. But I'm looking forward to a slow August where I get to stay home and enjoy the summer here in Connecticut. I hope your portfolio is doing well and that you're doing well with your health and family wherever you may be. And we'll look forward to seeing you next month at our Lunchtime Stock Club.